everyone, welcome to today's exciting journey into the world of high-yield dividends. Have you ever dreamed of earning money while you sleep? What if I told you that there are hidden treasures in the stock market, ready to boost your income significantly? Today we're diving into the top 10 high-yield dividend stocks that could potentially add over $1,000 to your income. And guess what? Some of these stocks are so surprising, they'll make you rethink everything you thought you knew about investing. Stay tuned, because each stock we reveal today could be the key to unlocking your financial freedom. Hit the like button, subscribe, and let's embark on this profit-making adventure together. Trust me, you don't want to miss the incredible secrets we're about to uncover. If you want to make money through dividends, you've got two main choices. First is dividend growth investing. This is when you invest in companies that may not pay a lot right away, but their dividends grow fast over time. Then there's high-yield investing. This means putting your money in companies that give big dividends right from the start, though these companies might not increase their dividends much. 10 awesome dividend stocks that could quickly boost your income by over $1,000. Each of these stocks gives more than a 4% dividend yield, some even more. We'll look at each company, see how they're doing, and talk about their dividends and current value. First in our top 10 is Altria Group. With the stock ticker MO, Altria Group is a big name in dividend paying. It's one of the largest tobacco companies in America, facing a drop in cigarette sales for years. This isn't new for them. I understand investing in a tobacco company like Altria Group might not be everyone's choice. If Altria Group doesn't fit your style, no problem. Just skip ahead to our second pick. But if you're interested, let's talk more about them. They're a major player in the US tobacco market, worth $73 billion. Their stock has fallen 9% in the last year. Yes, they're selling fewer cigarettes, but they're smart about pricing, especially for addictive products. They're also trying new things, like heated tobacco, smokeless products, other nicotine items, and even cannabis. This variety helps them make a lot of money, allowing them to pay out a big dividend. Right now, their dividend yield is 9.4%, one of the highest in our top 10. They've increased their dividend for over 50 years, making them a dividend king. Talking about value, Altria looks strong. Experts think they'll earn $5.10 per share in 2024, giving them a price-to-earnings ratio of just 8.1, which is lower than their 5-year average of 10.2. So with Altria, you'll get a high yield and a low valuation. Next, we're looking at Chevron Corporation, ticker CVX. Chevron's a big name in oil and energy, not just in the US but all over the world. They've got even bigger after buying Hess in 2023, still being reviewed. Chevron's market cap is huge, at $277 billion, but its shares have gone down over 15% this past year. Even so, their money situation is strong, and with crude oil prices around $70, things are looking good. Chevron is great at making lots of cash, which they use in different ways, including paying their shareholders. Chevron has a clever plan for rewarding its investors. They've set up a huge $75 billion program to buy back shares, with no planned end date. They aim to buy about $15 billion in shares each year. This is good news for you if you're investing, because when Chevron buys its own shares, the ones you own become more valuable. Besides this, Chevron also gives a strong dividend, now at 4.1%, and they've been raising it for 36 years in a row, making them a dividend aristocrat. Experts think they'll earn $12.89 per share in 2024. This means the stock's price-to-earnings PE ratio is lower than usual, at just 11.4, way below their usual 14.5. Now let's look at our third choice for high-yield dividends, British American Tobacco, ticker BTI. They're a lot like Altria, but operate globally. BTI has the highest dividend yield on our list, a huge 9.5%. Let's dig into BTI. They're valued at $67 billion, but their stock has dropped over 20% last year. High yields like this often mean slower dividend growth, but they're still a good choice for value. Analysts expect BTI to earn $4.82 per share in 2024, putting their forward PE ratio at just 6.3, a real bargain. Next, we have Enterprise Products Partners, ticker EPD, an energy giant. They manage over 50,000 miles of pipelines in the US, moving oil, natural gas and other important energy stuff. They're worth $59 billion and their stock has gone up 5% in the last year. They're doing well financially, which makes them even more attractive in the energy sector. EPD is famous for its big dividends, with a current yield of 7.7%, and they've been raising their dividend for 25 years. Analysts think they'll make $2.67 per share in 2024, leading to a further PE ratio of 10.1, below their 5-year average of 11.1. Our fifth high-yield stock is Verizon Communications, ticker VZ. They're big in the telecom industry, competing with AT&T and T-Mobile. With today's need for data and wireless services, especially with more people working remotely, Verizon is very important. They have a market cap of $162 billion, but their stock went down about 8% last year. However, in the last 3 months, their shares went up over 20%. Verizon is great at generating cash, which helps them pay their big dividends and manage their debts. Verizon's great at making extra cash, which helps them pay off their debts and keep up their dividend payments. And talking about dividends, they're really good in this area. Since we're focusing on stocks with high yields, it's important to mention that Verizon offers a strong dividend yield of over 7%, and they've been increasing it for 19 years straight. They're known for their high yield and low value, with a PE ratio that's really low. Experts think they'll earn $4.60 per share in 2024, which means a PE ratio of just 8.4, much lower than their 5-year average of 10.5. Moving on to our sixth high-yield stock, we have Vici Properties, ticker VICI. Vici is a big name in real estate and owns a lot of property on the Las Vegas Strip. It's also the largest real estate investment trust, REIT. Vici, worth $32 billion, saw its stock go down 8% last year, mostly because of rising interest rates. But things might look up soon, as suggested by the Federal Reserve. Vici has some famous properties like Caesars Palace, MGM Grand and the Mirage. They haven't been public for long, but they've been consistently increasing their dividend, which is rare for high-yield stocks. Vici offers a 5.3% dividend yield, and their dividend has grown 10% over the past 5 years. For REITs like Vici, we don't look at EPS to judge their value. Instead, we use FFO, or Funds from Operations, which is better for REITs because it includes the big costs of owning a lot of real estate. For 2024, experts expect Vici's adjusted FFO to be $2.25 per share. This puts its price to FFO ratio at 13.8%, lower than its 5-year average of 16.5. This could mean Vici is a bargain right now. Next, we're talking about another REIT, Realty Income, ticker O. Realty Income is popular because it pays dividends every month and is known as the monthly dividend company. They're valued at $43 billion in the market, but their stock went down over 10% last year, mostly because of rising interest rates. Even with these challenges, Realty Income stands strong. They own more than 13,000 properties and are always adding more. They mainly focus on retail spaces, but are also getting into industrial warehouses and gaming properties. Currently, Realty Income offers a dividend yield of 5.2% and has been raising their dividends for 26 years, earning them a spot as a dividend aristocrat. To understand their value, like with Vici, we look at FFO or AFFO instead of EPS. This gives a clearer picture of their real worth. Realty Income is expected to get an AFFO, adjusted funds from operations, of $4.19 in 2024. This means their price to AFFO ratio is at 14, a lot lower than their usual average of 19.1. This could be a great chance for investors to think about the long run. Now let's talk about our eighth high-yield stock, Pfizer, ticker PFE. Pfizer is a well-known name in the medicine world, especially famous for their COVID-19 vaccine. But after the pandemic, their sales dipped a bit, making investors a little worried. Now Pfizer is getting back to its main business areas, which have recently grown by 10% in non-pandemic related sales. Pfizer is worth a massive $162 billion, but their stock dropped 40% last year. Even so, the growth in their regular sales and a strong lineup of future products looks promising. On the dividend side, Pfizer gives a good 5.9% yield, and they pay out about half of their earnings as dividends. As for their value, it's pretty attractive. Analysts think they'll earn $2.24 per share in 2024, which puts their PE ratio at 12.8, just under their usual average of 13.2. Next, we have International Business Machines, or IBM, our ninth high-yield choice. IBM, a big name in technology, has been around a long time and is still going strong. Their stock has gone up 14% and they're valued at $151 billion. IBM is changing things up, bringing in new ideas and reshaping their business, making them an interesting option for those into technology and looking for stable returns. IBM is still a key player in the tech world. They're focusing on modern tech like artificial intelligence and blockchain technology, both super popular right now, especially with the rise of Bitcoin. IBM's work in these areas shows they want to keep leading in tech innovation. Even with tech prices going up, IBM stands out as a good investment, especially with their tech focus. On the dividend side, IBM offers a 4.7% yield, and they've been increasing it for 28 years, making them a dividend aristocrat. The increases are small but consistent. For their value, IBM's average PE ratio has been 14.3 over the last 5 years, and experts expect them to earn $9.88 per share in the next 12 months, leading to a forward PE ratio of 16.7. If you want a mix of tech, high yield, and good value, IBM is worth a look. Finally, we're at our 10th high-yield dividend stock, Hasbro, ticker HAS. You probably know Hasbro as the big company behind famous toys like Play-Doh, G.I. Joe, Monopoly, and Nerf. They're the smallest on our list with a market value of $7 billion, but they're a big deal in the toy world. In the past year, Hasbro stock has gone down more than 25%, with a lot of that drop happening in the last 6 months. This could be an interesting chance for investors thinking about the long-term future of this famous toy maker. What happened with Hasbro in the last 6 months? At the start of 2023, people were spending a lot, but as the year went on, spending on extra things started to drop. Things like high credit card debt and paying back student loans made people spend less on stuff they don't need, like toys. Hasbro sales have been going down for 2 years. Now, their CEO is changing things up, focusing on areas that make more money and getting into gaming. This plan could help their earnings and profit margins over time. Investors might need to be patient here, as Hasbro offers a 5.8% dividend yield. For their value, analysts think Hasbro will earn $3.79 per share in 2024, which means a PE ratio of 12.8. This looks pretty good compared to their usual PE of 21 over 5 years and 18 over 10 years. If you found this video helpful, please subscribe for more updates. Leave a comment below with your thoughts or questions. Remember, your financial journey is as unique as you are, and here's to your investing success. Profitable investing